Hello and welcome to the July edition of Amundi's Market Review. The recent repricing in equities and bonds was caused by still high inflation readings, fears on economic growth, and more hawkish central banks hiking interest rates steadily higher. Equities displayed divergences, while US and European markets were very weak. Chinese and Hong Kong stocks were boosted by positive news around economic reopening in the country. Bond yields proved volatile as the US 10-year yields climbed to almost 10-year highs, owing to hawkish actions and comments from the US Federal Reserve. Subsequently, as concerns over economic growth took precedence, yields fell below 315 towards the end of the month. On the economic front, stagflationary fears appear more pronounced now, particularly in the Eurozone, where added to this inflationary environment are risks of a technical recession, mainly due to weak private consumption and investment. We have not yet factored in gas rationing in our calculation, though. Should this occur, it would create even greater downward pressure to the Eurozone economy. In the United States, we recognize that the economy is more resilient and believe growth should remain positive but could move below potential in the fourth quarter this year. This is because we consider the strong labor market and consumption in the United States, as well as low unemployment, as inconsistent with a recession. In emerging markets, we remain constructive on commodity values and as such on select Latin American countries. In Asia, China has now returned to a positive quarterly growth sequence thanks to its recent economic reopening and a supportive policy stance. Overall, the toxic mix of low growth and high inflation is a major issue in the near term for the global economy and the corporate sector. In corporate earnings, we see more pressures building in Europe, but less so in the United States. Rising input costs, supply chain constraints, and the fallout from trade wars and geopolitical tensions could continue to threaten and undermine corporate profit margins. The July reporting season should shed more light on this. As a result, we focus on companies that display strong cash flows and robust balance sheet, as well as a command pricing power, with the ability to pass on increasing input costs to consumers. Such businesses are likely to preserve margins in a difficult environment. With this backdrop, we believe investors should remain well diversified and agile, given that the market repricing may not be over yet. The recent fixed income sell-off has made the asset class selectively more attractive, as the central bank's hawkish views are now priced in. We also think that at some point central banks may be forced to do less tightening than that they've been committed to in order to avoid a deep recession. This should prevent yields from rising very high. The task of the European Central Bank is particularly difficult as it has to tame inflation and at the same time prevent fragmentation of the divergent EU economies. Overall, we are now more positive than before on duration and stay close to neutrality in the United States and in core Europe, but very flexible and active in our allocations. In the credit sector, investors' allocation should be driven by long-term earnings growth potential of companies. They should consider including more high-quality credit and be more selective across the board. On a regional basis, our preference for US investment grade remains in light of the strong consumption and labor market there. We also maintain a slight preference for emerging markets hard currency debt, but very selectively. On equities, we keep on an overall vigilant stance with caution in Europe and a preference for the US, and now also China. In terms of style, investors should prefer lesser cyclical equities, not so impacted by the trajectory of the economy, such as value, quality, and dividend-oriented stocks. To conclude, the current repricing is not an opportunity to indiscriminately add risk to portfolios, buying back into markets, because there are maybe more downsides yet to come. Instead, investors should move towards more quality areas in equities and in credit, and aim to benefit from the regional divergences in the United States, Europe, and emerging markets. In addition, a well-diversified stance that includes commodities such as oil and gold-related values would allow investors to navigate the volatility ahead. Thank you for listening. Please keep safe and see you next month for another market review.
TMB และธนาชาติเปลี่ยนเป็น TTB เปลี่ยนเพื่อให้ชีวิตคุณดีขึ้น